We are here today to talk about SaaS metrics-based planning together with Drivetrain and Whatfix. We're so excited to have our guests today. We are focused on the key SaaS metrics today that are the most relevant indicators of healthy SaaS companies. And I am so excited to have two great speakers today. Alok Goel, CEO and co-founder of Drivetrain. Hi, Alok, welcome.
Hi, Lauren, thanks for having me here.
And Amit Sharma, who's the Senior Finance Director at Whatfix.
Thanks, Lauren, for having me. Quite excited to kick off a great show.
I think we're representing several different time zones here. So I'm based in Boston. Alok, you're on the West Coast?
That is correct. I'm in Bay Area.
And Amit, where are you based?
I'm from India. I'm in India, Bangalore.
So thank you for being here this afternoon. We're going to start off talking about what metrics investors use to value SaaS companies. But then we're going to dig into operationalizing that. So I'll just give a quick background. I'm Lauren Kelley. I'm the CEO of OPEXEngine. OPEXEngine is a SaaS and software benchmarking platform. We benchmark about 300 metrics across the board, a 360 view of SaaS companies, from financials to every major department of the company, expenses, headcounts, productivity measures. We actually have worked with hundreds and hundreds of companies. We have about 1,000 companies on our platform, and about 70% of the SaaS companies that have IPO'd in the US over the past 10 years have worked with us in benchmarking and improving their growth positions over the past 10 years. We were acquired recently by Bain Consulting, Bain and Company, and we're excited to work with Bain. And Alok, I'd love to learn a little bit more about you and Drivetrain.
Thank you, Lauren. Hello, everyone. I'm Alok, CEO and co-founder of Drivetrain. We are a financial planning, monitoring, and decision-making software purpose-built for SaaS companies. And as a result, we have been working with a lot of different SaaS companies. And before starting this company, I used to be a VC. I was a partner at a venture capital fund called Elevation Capital, where I set up and managed their SaaS investment practice. It's a large fund, $670 million fund. And before being a venture capitalist, I used to be an entrepreneur. And I built and sold 2 companies in fairly large size M&As, and quite excited to be here and looking forward to engaging discussion with Lauren and Amit.
And I think, look, you can also mention that you, at one point in your career, worked for one of Bain's competitors. A company called McKinsey. So Amit, great to have you as a real operator and right in the trenches and dealing with this every day.
Thanks, Lauren. I'll just maybe give a quick intro. My name is Amit Sharma. I manage finance and legal at Whatfix. Whatfix is a B2B SaaS company, ballpark range of around 50 million plus ARR, focused more towards the North America region in terms of revenue, enterprise heavy. So that's a little bit about me and Whatfix.
Excellent. Well, excited to hear more. And it is amazing, the world that we're living in, the connections between the US and Indian companies and European companies, but I think the US and India, I've been impressed working at Bain. Bain has a big presence in India, and just seeing the connections particularly between California and India. More need to come to the East Coast
That's right.
Right. So in our prep sessions, we were all sharing kind of what the key metrics that we see investors focused on. And, I think these metrics are familiar to anyone in the SaaS industry, whether you define your company by your subscription revenues, ARR, or if you're a larger company, particularly public companies that are driven by, GAAP metrics, recognized revenue, growth rates, EBITDA, rule of 40, magic number, retention rates, and I'd love to dig into specific retention rates a little bit more. And then at the unit economics level, CLV or LTV to CAC. And I think, Alok, you have a great perspective, having been on both sides as an investor and an operator. What do how did you come to this, and what do you see as the key metrics that boards and investors are looking at?
Yeah. Actually, when I set up the SaaS investment practice in my VC fund, like 8 years back, many of the people were not very comfortable investing in SaaS as a space. It was not the hot space at that point of time. And every now and then some metric would come and people will say, okay, now the valuation of the company has to be determined on this metric, that metric. And it used to be a bit confusing early on. And then I started putting my thoughts together in terms of what do each of these metrics tell us? Why are they actually important for the businesses? And then I sort of, as a VC, discovered that there's something funny about metrics. When any metric becomes a target, it ceases to be a good metric, because what happens is that these metrics will be gamified and will potentially hide some of the other deeper problems that are there in the business. But as an investor, you are basically making a decision in terms of if you invest $1 in the company and will you get risk-adjusted return or not from that company. And arguably, as an investor, the best way to estimate company's worth is to perform a discounted cash flow analysis based valuation. Many of you might have heard of this. If not, maybe it is worth spending like 10 minutes reading about this on the internet, but this is actually the most comprehensive method of valuing any particular company. But it is not that straightforward of a method that can be applied in a particular SaaS company, because first of all, this method relies heavily on the forecasting of the cash flow, free cash flow of the company. But most of the private SaaS companies don't even have a free cash flow. But let's say some company has some kind of a free cash flow, but it decides to invest that cash flow in terms of growing faster, and that company deserves credit for that. So you really can't just use the basic vanilla free cash flow and then start doing the valuation of the company. You start sort of looking at some of the other proxy metric to come up with that proxy of what is the potential of this business in terms of being able to generate the free cash flow. And that is where the rule of 40 comes into picture, because it brings in a good balance between actual cash flow that is being generated and then the growth rate that the company might be actually taking as a strategic call in terms of investing for the future growth. In fact, over the last 1 year, as a narrative of growth at all costs got replaced by growth at a reasonable cost, the whole R-square correlation for this rule of 40 has gone up by 80%, and that of the growth has gone down by 50%. So a large part of today's predictor of the company's valuation is actually rule of 40. And as I mentioned, one metric can never or should never be the target for any investor or for any entrepreneur or CEO. And SaaS companies are in particular also have this characteristic that these are annuity businesses where you invest today and then you sort of get benefit over a long period of time. So another thing besides this rule of 40, which is just a pure basic vanilla metric of getting some kind of cash flow prediction for near future, you also need to understand whether this cash flow will translate into the real cash flow over a long period of time, which basically means is this growth sustainable or not. And that is what brought in metrics like GRR and NRR into the picture when doing the valuation of the company. So when you now look at these 4 metrics put together, you get a decently good picture of the free cash flow potential, long-term free cash flow potential of the business. But now the real question that is left is what is the break-even cost of capital for generating this cash flow? And for this, it is quite important to understand, are you spending $1 today to earn more than $1 in the future, and how much more? And what will you need to spend in future to earn $1 in the future, right? These are basically the decisions that you're making in your business that are also important from understanding the cost of capital of your business. And from that perspective, adding metrics like magic number to measure the sales and marketing efficiency, and the gross margin number or a metric to add a view of the cost of serving the customer, added that perspective of the cost of capital. So now when you put these 6 metrics together, you get a very good holistic view of everything that you require for performing this DCF analysis to find the value of the company. And the funny thing is now today, not many investors, or actually pretty much nobody does this DCF analysis. These metrics have become like the proxy or the thumb rule for valuing the business. So the fundamental math is not being used, but the derived sort of tribal knowledge of that math in the form of these 6 SaaS metrics are the ones which have become thumb rule for valuing a particular business. Now, this is as far as the investor story is concerned, and why these 6 SaaS metrics are being talked about quite a bit in the industry, and why they are the main ways in which investors are using for valuing the company. But the other question that this raises also is that it puts in a challenge for the CEOs and CFOs in terms of, you are promising these 6 SaaS metrics to the investors and prospect investors, but you deal with your team on a day-to-day basis. Those teams are asking you for prioritization. Those teams are asking you for resources. How do you sort of decide what to do on the operational basis, which are actually aligned with these metrics. Because at the end of the day, you're working hard to increase the value of your company, the value that you're creating out there. And initially, it feels like a good amount of disconnect. But the way I see is that these are really two sides of the same coin. So as Amit will talk about in a lot more details, once you set some of these kind of SaaS metrics from the investor side or the valuation side, you start sort of putting together the target numbers for your operational numbers as well. So for example, if you set the rule of 40, you also sort of set the growth rate, and that basically gives you how much EBITDA burn you can actually aspire to, or you're okay to burn in the business for the next year. And Amit will talk about it in a lot more detail, so I'll not get into the mechanics of this. But net, the way I see is that when you bring in these two things together, everything aligns well, both in the boardroom as well as in your day-to-day decision making on the prioritization in the company. So that is a little bit of my story of how I put together these 6 SaaS metrics in sort of harmony with each other in terms of why investors look at them and what is the value that they bring onto the table with respect to valuing the business.
Yeah, I think that's really the key, is how do you bring together the investor's perspective of valuing a company from the outside together with the operator's goal A, and maximizing the valuation of the company, but then operationalizing, achieving the best metrics. What we're definitely seeing in 2023 is a deeper dive into what the metrics mean. So rule of 40 is fine if it's just a number, but it's really the addition of two things that used to be sort of opposed: the EBITDA or free cash flow number plus the growth rate. And you could get to the number 40 or the number 50 a couple of different ways. You could have 10% growth and 50% EBITDA, but that's not as valued a company as a company that is 40% growth and maybe 10% EBITDA, or what you used to see, and you still see with some companies, negative 30% EBITDA, although that's also an attractive company in some ways because the investors say, oh, well, I can just improve that and then increase the value of that company quickly. So Amit, I'd love to get a sense from your perspective, what you've seen, what your board's.
I can start with my perspective. Alok is lucky to have both sides of the coin as an investor as well as now as a CEO. But to a lot of questions on the Q&A as to which benchmark should I track, where will I get valued more? Am I top quartile, not top quartile? I think, look, it depends on the stage of the company. Alok gave you a 360-degree view of what matrices are there in the market. It depends on what stage of company you are. When you're very, very small, and if you're an early stage company, all of these matrices may sound gibberish to you because you'll hear it in a board meeting when one of the investors say that, hey, by the way, what's your rule of 40? And then everybody scratches their head to figure out what rule of 40 is. You'll reach a stage at the company when it's large enough where all of the matrices that Alok detailed in his previous conversation becomes of paramount importance. And only then you will be either top quartile or you will be valued the most. So I don't think it's a either or. It can't be 3 out of 5 matrices I'm doing really well. Market demands you today to be fairly good in all 5 of them, like how Lauren mentioned in company A versus company B example. You need to hit the ball out of the park in all of those 5 matrices. It cannot be either or. Lauren, do you want me to walk through the dynamics of what we did at Whatfix with the slide, or do you have any other question?
Yeah, I think that would be great. I think we want to talk about the high-level metrics and then how you set the targets to achieve those metrics. And then, OPEXEngine also has a methodology for helping companies figure out below that level all the detailed drivers that contribute to those metrics. And where the efficiencies and inefficiencies are. But just to the point, I just want to clarify a few things from some of the questions we've gotten. One was, what metrics do VCs look at? And it's not clear to me whether, because we've talked about investors. And I think, Amit, you made the point, which is really important, which is that the key metrics for a company that a VC is looking at, maybe in the $10 million size, are different than the metrics that a PE firm is looking at in a $100 million or $500 million companies. So there's differences there. And I think here you have a good example of a company sort of in the growth stage in, 80% growth, 40 million. That's a great looking company in that stage. At a, $10 million level for VCs, they're looking at a lot of operational metrics. The company may not have as formal financial metrics as a $100 million company would have. Gross margin can vary widely at the early stages, but generally generally investors just in a scan are looking at companies with a gross margin somewhere between 65, 75% maybe, to ensure that they are actually a SaaS company or a software company as compared to, really a tech-enabled services company with a lot of services that would drag the gross margin down. Magic number at the, for smaller companies, I think there's not as much association with that with valuation as there is at later stages. And same thing with net dollar retention or, gross retention. You have to have a customer base in order to have well-established retention rates. And you also have to, to have a net dollar retention rate of 125%, you would have to have a land and expand model, which if you're selling in the SMB, you're not going to, by the nature of SMB, they're not going to spend 25% more every year on their contracts. It's more of a volume transactional business. So it also varies on the type of businesses. But yeah, I think it would be great, Amit, if you could just take us through how you took what the board, maybe would set as targets, and then how you come to those targets underneath that.
Sure. Thanks, Lauren. So maybe I'll set a disclaimer before I start that I'm trying to talk from a growth stage company. So depending on where you guys are individually with your ARR, take this data with a pinch of salt. The second disclaimer that I would call out is that it's very important to benchmark some of these matrices, of course, with competition. Bain has, OPEXEngine has some great data. You find a lot of benchmarking on the internet as well. Discount it to some extent when you start this exercise, and if you're doing it for the first time, discount it. I fear that when companies get very optimistic with what they want to achieve, they will break the system. You cannot achieve your North Star overnight. So take baby steps towards it, have a plan of maybe a year or two to achieve what you want to achieve. But maybe I'll quickly explain on how we did the planning. So let's start with the ARR. You will have an ARR growth number in mind that your board wants to chase. Put that down as that number. You will have the next derivative, which is your GRR. Now, your GRR in layman languages, you have already revenue in the bank. You will retain a certain percentage of it. You will subtract that percentage of what you can renew from the new chase, which means that you will get net new addition that your team needs to do either in land, which is brand new sales, or expansion, which will contribute towards NRR. So if you have these three matrices, which is what growth rate you want to achieve, what GRR you can hold for the year, what expansion you predict for the year going forward, you can actually get what the ARR dollar value will be split between direct sales, which is brand new sales, your customer success revenue, which is your renewals, and your expansion team, which is a derivative from the land. After you get this, if you go to the immediate next step, you should be going towards gross margin. So now gross margin is important, as both Lauren and Alok detailed, is because that will show how much COGS you're actually putting back into the business or maintenance of the current existing accounts. Now, that is possible with the nuance that your customer success team is only doing renewals and not doing expansions with renewals, which happen in different companies. If you know what that gross margin looks like in terms of a benchmark that you have, in this example, 80%, from your revenue, you can directly derive what will be my COGS. Now that COGS will get split to the team basis, payroll cost, staff welfare cost, purchasing tools, And then you get what that budget for the customer success team looks like. What I will do is go one step further, which is not in the slide, is also have benchmarks for your R&D team. What percentage of R&D cost to your revenue you should chase? Now, again, that depends at the stage of the company you are. If you feel that you need to do heavy investment in your product, then that percentage needs to go higher. If you think you have a stable product with not too many SKUs left to build, then you drop that percentage and try to maintain and maybe go for only feature enhancement in your product. You can go down that line, get S&M efficiency, which is nothing but magic number. You derive what percentage you want. Let's assume, for the sake of example, that you want a 75% magic number, which basically means that for every dollar you spend towards the sales and partnership team, you will get 75 cents and 0.75 cents in return. Now, even when you have that derivative, it becomes easy to split that cost again between marketing team and sales team. So coming to the S&M part, and I feel in my head, it's a very leaky bucket. And I'll tell you why I feel it's a leaky bucket. People have a sales efficiency number in mind, but they don't know how to split it between marketing and sales. Now, what you should be doing is do something called as capacity building for your sales team, which means that you go ahead and you build the number of reps that you have, break it between ramping and ramped, derive a quota number that they will chase for the year, assuming that all of them are there in the system. You will get what your sales team needs in terms of cost. You'll have to do the same version with marketing as to how much money marketing will need in terms of generating leads, basis past performance with, of course, some uptake because efficiencies will improve even in marketing. And then that amount gets plugged into S&M. Doing S&M efficiency, quoting a number in terms of magic number that you want to achieve without doing these two steps will continue to leak the bucket until you plug it over there. So I would urge everybody to do a little bit more research on S&M part because it's not as straightforward as it looks. If you don't do capacity planning both at sales as well as marketing level, it is going to continue to leak, and it's very hard to pull back these matrices. Of course, we hear a lot of people saying it's quite easy to shut down marketing. All that you need is go up to your marketing team and say, stop Google AdWords, stop LinkedIn words. You can stop that, but then the growth target will take a severe beating. One of the easiest tabs to close is marketing, but be very, very watchful when you close that tab because it does have ripple effect to a lot of other planning that you did.
And I think maybe there's a question just to recap. I think you did a great job of really going to the next level below the key sort of board metrics that might be set as targets to how do you calculate what your target should be for operating expenses, what your target should be for sales and marketing, what your target should be for COGS, what your target should be for EBITDA margin. But that's not the end of the story. You can't just hand that off to the organization and say, okay, do it. The next level beyond that is trying to decide what the resource allocations should be within operating expense, what the resource allocations even within sales and marketing should be. And you referred to the leaky bucket. I'm sort of playing around with, it's funny, the leaky bucket originally came out as a great way. And I think it was actually the CFO of NetSuite who really popularized this and kept talking about it, which is the leaky bucket is that you can put all this money into sales and marketing to get customers. And then if you're not retaining them as a subscription business, you're wasting all that money you're putting into customer acquisition. If you're losing 40% of your customers, it's like a bucket that you're filling with a hole in the bottom. But I actually think because the last couple of years, the focus has been so much on net dollar retention and expansion. And I think what we saw in 2020 was agile companies when the world shut down and it was pretty hard to acquire new customers. A lot of companies focused, unless you were Netflix or somebody who was perfectly adapted to a COVID world, selling remote, Zoom or selling remote tools. Most companies really moved resources into customer retention. And, let's keep those salespeople occupied as much as possible on customer retention. And then you have investors and blogs all talking about all this, Snowflake has 180% net dollar retention. Everybody should do that. Even if you're selling a $10,000 product and your customers no way are going to double the price every year. But I think now we're seeing the reverse of that, which is there's a leaky bucket in new customer acquisition, that companies are not focused on efficient new customer acquisition. And they're not making sure that you continue to have that, because you're always going to have churn. No matter who you are, you're always going to have churn, obviously more in SMB than in enterprise. But how do you take it to the next level? I mean, we do it through benchmarking and helping companies see what other companies are doing. But I'd love both Alok and Amit to get your perspective on, I'm particularly interested in the sales and marketing question, is how do you make sure within your companies that you've got the right focus at all times and the right resource allocations between new customer acquisition and retention? I'll turn it back over to Alok for your perspective on that, and then Amit, have you also chime in.
Yeah, at the end of the day, new customer acquisition and retention are basically these are the holy grail of questions, right? If you are focusing way too much on growth right now, you're not going to be able to, and you have got a leaky bucket, as you said, on the churn side, the long-term growth is going to get compromised. But at the same time, the conundrum is that every investor actually wants to see the growth. So you have to actually start focusing on the growth as well. Both have to be done at the same time. And then you talked about this whole point of churn will always be there. That is actually the most important thing that we need to understand. That churn is characteristic of the business. Enterprise SaaS company may have a lesser churn, whereas a SMB SaaS company may have a higher churn, but it is characteristic of the business. And what I see is that it is a good idea to actually always refer to the benchmarks in that context, in terms of for my stage of companies, my kind of business models, my kind of space, or the kind of customers that I'm selling to, what is the kind of churn rate that is expected out there, and then back calculate numbers according to that, like Amit was talking about. If you see that you're an enterprise SaaS company and your churn gross dollar retention should be like 95%, then you actually plan according to that. But in maybe SMB, you might be targeting more the 85% kind of the number. So you plan according to that, and then you set your account management target, your customer success team's targets on the basis of what is the kind of churn rate that is there in the benchmark. And benchmark also does something magical in the companies that I've seen. So for example, last month I was talking to one of the founders who is running a company at like $500 million valuation, something like that range. And he told me, whenever I go and talk to any of my team members in the sales, marketing, or let's say customer success, and I say, can we do better? They always say, oh, we have already been doing better. Whatever we were doing yesterday, whatever we were doing last quarter, whatever we were doing last year, we are actually better than that. And now that person, that founder, has actually made a flip in his approach. He doesn't go and say, can we do better? He basically goes and asks the industry experts first in terms of what is the benchmark. And once he gets the benchmark, he goes and says to his team, hey, here is the benchmark for our kind of companies in our space for this particular metric. Where are we? And then suddenly the discussion shifts from justifying that we are becoming better over a period of time to a point of how do we make it happen? And that is actually what brings in a very, very strong alignment that this founder was telling me as an insight, which I thought is a very, very deep insight, because now your team is not justifying that we are making progress, we are better. Now your team is actually having this aspirational goal, which is out there from the benchmarks, and actually finding out how do we actually make it happen. That shifts the entire conversation in terms of bringing in alignment and figuring out a way to make it happen rather than justifying, hey, we are already making progress.
I love you. That's a perfect setup for, what we do at OPEXEngine, because I spent 20 years before starting OPEXEngine in executive team meetings and going through different transitions. And it's exactly right. Growth, we're all in the tech industry and, very creative, hardworking people, but it's very hard to get people to look at outside data and really make the decision as to how well they're doing and be aligned with everyone else by really understanding what the benchmarks are. And it changes the conversation when you can look outside. And I think you described it really well. Instead of going to someone and saying, no, you're not doing as well as you think you are, because other companies are doing better with the same resources. Here's the data, here's what other companies are doing. How can we achieve this? Because I think there's some questions in the Q&A about, do I need to be top quartile? I think there are certain metrics where if you can be top quartile, then you'll have a higher valuation. Things like growth rate. You want to be top quartile in terms of retention rates and churn rates. And there's certain areas where absolutely, if you can achieve top quartile, that is fabulous. You don't want to be top quartile in terms of your spending. That's not something you want to be top quartile on. Magic number is not something that you necessarily, it's good to be in the top quartile. You want to be within a certain range, ideally between, say, 0.5 and 1.1, 1.5 maybe. You could invest more money and you could have an even higher growth rate, because growth rate is what you want to be in top quartile. So I do, we see it over and over again. One of the things we hear from our customers is, one of the biggest value adds of having a third-party benchmarking system is that it brings the executive team and the investors and the board into alignment on what are realistic targets. Not that benchmarks are a blueprint for any given company, but you need to know where you stand either above or below the benchmark and be working on that. I think your comments reflect, I'd be interested in what Amit has to say about that as well.
Lauren, so I'll maybe give you a walkdown of what happened at Whatfix. We used to do planning for the heck of it. It was a number that was left on an Excel sheet. What I felt was instrumental was the benchmarking side, because the benchmarking side suddenly gets a mindset shift, not only to the leadership, but the one level below them and the one level below them also. That ripple effect of ensuring that we are way off the mark and where we want to be in the top quartile, then settles down really well when you actually do the budget versus planning. It's a very tough conversation without that to go to your CRO and say that, hey, listen, this is all the money that you have. I want you to do 3 times the revenue with the money that I gave you. It's a very hard conversation to have. Moment you have benchmarks to say that we ideally want to be here in 2 years. Let's work backward. Let's move slowly the needle, because when you're a very large growth company, to make even 1 basis point movement takes a mammoth effort, just because of the quantum of dollars that you are dealing with, both in the inflow side as well as the outflow side. So I resonate with both you and Alok. Mindset shift because of benchmark plays a very, very crucial role for you to achieve what you should. I also feel that then that benchmark gives you the North Star that you need to chase. If that's possible in a year, if that's possible in 2 years, that's something that's left at the discretion of the company. But at least it gives you a sense of direction of where you should be. Compare that to your current numbers. Are you off in retention? Then do something with your customer success team. Are you not so great in expansion? Do something with your expansion team. Are you not landing enough? Because at some point of time, you'll reach a deadlock where your marketing cost will be really, really high, and your only source of revenue then becomes expansion. So do you have enough land logos for the expansion team to chase? So I think that mindset can happen only because of benchmarks, because I would lie if any one of us would say that we feel we are not the best. Only when you start comparing it with other marquee leaders that are there on the leaderboard is when you get a sense of direction of, okay, there's a lot of work to do still. So I think the change is the benchmark that makes that lever move and makes people think in the right direction.
Yeah, no, it's motivational, and it's a way to align companies. Align executives. We have a specific question here about the inputs to CAC and calculating CAC. And I'll give my perspective on that for different size companies, because we work with hundreds of companies, helping them both define their CAC and benchmark their CAC. And first and foremost, I think the important principle is typically CAC is the cost of new customer acquisition. Some people are talking about including sort of cost of new customer plus the expansion maybe in the first year or something like that. But whether, you have to decide whether you're including expansion or just the initial new customer acquisition. And then you have to really be clear about the principles. So it's the inputs that go into and the expenses for acquiring a customer. So it's not an accounting, here's the black and white 1, 2, 3 things that you always put in. It's not all of sales and marketing, especially as a subscription business. If you have $20 million in revenue, or you have $100 million in subscription revenue, then you have $100 million of customers. So not all your sales and marketing is going into acquiring new customers. So it could be a portion of sales, it could be a portion of marketing. One area that people forget about is a freemium model, some of the PLG motions, that is lead generation. It is not sales. It's not existing customers, even though they are users of your product, but you're doing that not for the goodness of your heart, usually. It's to turn them and convert them into customers. So the cost of that freemium hosting, marketing, viral, sometimes viral expansion doesn't happen all on its own, but you're investing resources to encourage it. That all is part of the cost of customer acquisition. But I'd love to hear from your perspective, Amit, how you operationalize that. How do you define, because it also changes from year to year, what you might be spending, the inputs. And so that's very frustrating from a process and systems perspective. And Alok, I'll follow up with a question to you, because I think, isn't that something that Drivetrain can help with, and give the executive team that final number? But Amit, how do you define that with your team and make sure that the systems are supporting that?
So Lauren, actually, I go one step further to your answer of what you just detailed out earlier. At Whatfix, we fully load the CAC. So when I say I fully load the CAC is, we have broken all of the teams into specific cost centers on your ERP, which means that any cost that gets tagged to that particular department forms part of your CAC. Let's take an example. You have reps that are reporting in the sales team. All of that gets loaded into CAC. Let's say that there is a tool that the sales team bought. They bought Salesforce, for example. All of the users are heavy towards Salesforce for sales. And therefore, the cost that you bought Salesforce for also gets loaded into CAC. Now, the rationale for me to do that is I very openly agree that it's a very conservative way to look at CAC. There are ways that companies do it. They take a portion of it, charge it to G&A, so on and so forth. But the reason I do a fully loaded conservative CAC is because I can get the true picture of what my CAC is. Now, when I want to benchmark it, if I'm already doing well with the fully loaded cost of CAC, then for me to be top quartile or even be a category leader of how CAC should be structured, it doesn't come as a surprise last moment for me. So mine is a fully loaded, all-inclusive costing of sales and marketing, regardless of it being lead generation. It includes even products. It includes travels to customers. It includes any sort of rewards and recognitions that you give to sales and marketing. So my CAC is a fully loaded CAC in that aspect.
Exactly. I think that is the right way to do it, because then you don't have surprises in the end. Alok, I'd love to hear your perspective.
Actually, I think one mental model that in general helps in resolving disconnects or philosophical questions in these kind of situations is, at the end of the day, your decision-making should be as if you're running it as a bootstrap business. If you're running a business out of your own pocket, how would you measure CAC? If you're building a flower shop, and you have to go and go to a large company to sell bunch of flowers for some event, you'll actually put in that travel cost also in your CAC. Like if you're building this business out of your own pocket. And if you're building this business out of a VC money, why would you not do that? Why would you not measure it that way itself? So what I think Amit mentioned as a CAC definition and what Lauren mentioned is exactly the way to go. Every single cost that is going in terms of getting the customers should be loaded in, whether it is some kind of PLG motion cost, whether some kind of a lead gen cost. I would argue even the basic cost like sales team travel and those kind of things should be fully loaded into the CAC cost itself. And that is how you compute the CAC number. Although your investors may have a different perspective, they may be asking for you to report CAC in a specific way, that this is my, and that particularly becomes important when you've got large size investors, because they have a very, very specific ways of measuring CAC numbers. And in that case, you can actually report them on that, on their metrics definition as well. But internally, you should actually measure it always on a most conservative way. Now, once you do that, then I think the question is about the benchmark that we already spent some of your time on. What should be your sort of aspirational number? And then the second question that comes is, where are you at this point of time? And that is like establishing the baseline of your business. My CAC is here. My CAC LTV is here. The CAC LTV ratio is here. And then you basically figure out a way to bridge that gap by way of operationalizing, and like Amit was talking about the strategy. But when you talk about this baseline, that is actually where things become tricky, because different teams in your company will come up with different kind of CAC definition numbers. And that is one of the key things in which we help companies in terms of standardizing their metric definitions, getting data from all across their company, and then bringing in that one single source of truth and saying, this is our baseline definition of CAC. This is the aspirational number of CAC by benchmarks. And then let's actually now make a plan and figure out how do you actually go from point A to point B and make the business more successful and in a predictable manner.
Yeah, I think that's absolutely right. And I think one thing that you mentioned, but I want to emphasize, is you may have one way of reporting to investors or to the, if the board is made up with investors, it may be the board as well. And then an internal view. I think for the internal view, you just absolutely have to be honest and realistic about the costs of your business. And I absolutely agree. I love that perspective of, think of your business as a bootstrap business, regardless of how it's funded or whatever, because you have to understand that. For example, I'll go back a good 5-6 years ago when more large enterprise SaaS companies had significant amounts of professional services. It was required for implementations, customization, and to support the larger enterprise installations that they were doing. But what you often saw was that what they would report was customer lifetime value based on a gross margin only on the recurring revenue. And absolutely their CAC ratios and CLV to CAC would look really great because they were only looking at the recurring revenue gross margin against the cost of customer acquisition. But that's not the real cost of the business, because it's not like professional services or those one-time services were just a different business, and so the gross margin from that shouldn't be included. I think if it's required for your business, you have to internally understand that. And even if you don't want to expose that because your plan is over 5 years to productize everything and improve the product so that you don't have that, you have to be honest about it. And we talked about CAC and the input for CAC. There's a great question on good metrics for measuring the effectiveness of marketing. And marketing is one area that, sales, it's pretty easy to look at sales productivity and sales expenses and, sales cycles and quotas and quota achievement. But on the marketing side, there's a lot of activity metrics, and we really like to focus from a finance or corporate perspective on the productivity of marketing as compared to just the activity of marketing. And I'd love to get your perspectives on what are, from a finance and from a, executive management board valuation perspective, how do you measure the ROI of marketing to ensure that you're getting good, good bang for the buck that you're putting in? Sorry for using US dollar sort of based expressions. Amit, what do you think?
Yeah. So for us, marketing, we follow a very simple logic. So during marketing, when leads come in, it's a given that there'll be a lot of noise. Maybe all of the leads are not genuine. A lot of leads land on the landing page of the website, again, may not be genuine. So what we do is we take all of the leads, see what is SAL, which is sales accepted leads, which means that the leads go to the AE or the sale rep, and then he looks at what the prospect wants and then decides that, yes, I should qualify it as sales accepted lead. Now we go one step further from there. Once the sales accepted lead has confirmed, a lot of noise gets dropped off, which means that that's fine. You can also plan to ask marketing to re-nurture those leads, because some of them may be in a very nascent stage, maybe not the right buyer persona in terms of designation who opted to talk to you about your product. So they go back and nurture whatever is lost. When it comes to sales accepted lead, we also then track the funnel of the movement through various stages through the sales cycle. So you can actually do a math of how many leads came in from marketing to how many actually got closed and everything in between to derive what the conversion rate looks like from top of the funnel marketing right up to closure. Now, what you also want to proactively do is bring that ratio up, because that ratio, even from benchmarking, is quite scary when you look at it from a financial term, which means that it's single digit conversion rates. So to move that higher and higher, or generate more better directed leads, is also another way that you can become a little bit more efficient. So that's what at least we do at Whatfix from the finance side.
Alok, do you have any other thoughts on that?
Yeah, actually, this is a fairly controversial and political topic in any company.
Not just your company.
We work with a lot of different SaaS companies, and one very common thing that I notice is that sales being very close to bottom of the funnel and very directly attached to revenue is always held accountable in terms of ROI. Salespeople are always given commission on the basis of how much you are bringing in exactly, like now in this month, this quarter, this year, and the composition is very much directly linked. So they are always held accountable. But generally, all the CEOs and CFOs struggle in terms of how do you hold the marketing team accountable on the ROI? Because as you go up funnel, ambiguity start coming in. There are questions around attribution. Who got the lead? Maybe 6 months back, marketing touched base with the lead, but now salesperson actually created this as an opportunity. Now, who gets the credit? There are a lot of these political issues that get into this thing. So without getting into the attribution aspect per se, which is probably a topic of another webinar in itself, the key thing in my view is that we talked about so far around this magic number and sales and marketing efficiency as a collective number so far. I think it is fairly okay to sort of, in a crude way, break down these things and also then attach to the network. And I know Amit does this as a very good thing in his company in the form of this metric called Q factor, which is basically booking to OTE ratio, and they do it for all the functions. So the way it works is that you basically forget about sales and marketing spend as an overall spend. You look at your sales team spend, overall fully loaded sales team spend, and you basically take a ratio of how much new business is coming in and how much of new sales, how much of spend you have to incur on the sales team. And that is basically your sales team's ROI. Similarly, you take the marketing thing as well. How much is the business that your marketing team is generating? And you basically take all the marketing spend that you're incurring, all kind of marketing spend, whether it is payroll and various kind of events or other kind of stuff. And then you may have some kind of a proxy metric for the marketing ROI. Now, the problem that will happen is that in marketing, you can argue that it'll take 2 quarters or 3 quarters before your spend gets converted into the customer. So you take the ratios appropriately. They can all be based on your dynamic of the business. You don't have to go with one industry rule per se, because these are all internal metrics. They are not the standardized metrics per se. And then the question comes, how do you actually translate this into the more actionable things or short-term metrics for measuring team's performance? And that is where you can get into these proxy metrics like Amit was talking about. How many SALs are being generated by each marketing effort? What is the cost of SAL that is being generated? How much is the conversion rate from SAL to deals? Kind of the thing. So net, long thought, but what I'm basically saying is that break sales and marketing into some kind of a basic proxy metrics for computing ROI across every single department, every single team, whether sales or marketing or customer success or everything. And those proxy metrics can be further divided into some other indicator metrics. They all will be loosely related to each other. You'll get a good proxy of how your business is doing, how effective your marketing is. And at the end of the day, it is about making progress. It is not about getting stuck onto a point that, hey, my marketing ROI is 60%. That 60% number doesn't have a meaning. What is meaningful is that, is it going from 60 to 65 and then from 60 to 75 over a few quarters or years?
Yeah, no, I think that's very well said. I think I'm a big believer, and this relates to some of the questions here of, you as a company, you can't focus on any one metric. And particularly if you've seen any of the sort of layout of SaaS is a particular model that has many different inputs that are required to all be successful in order to have a successfully growing SaaS company. You need productive sales, you need productive marketing, you need productive product that is supporting product retention as well as the new customer acquisition. You need great customer success. It's not there's not any one target or any one number that can work in isolation. We benchmark MQL to close, and whether it's MQL or SQL, each company defines that slightly differently. So we take MQL as sort of the very top of the funnel, and then cost per MQL as a way to look at that. But I think when you're thinking about what metrics to set as targets, we've seen some great success in having both sales and marketing heads tied to the magic number and improving the magic number, because then they have to work together. Because otherwise you can always have, if you only focus everyone on the close rate, but marketing can always say, well, we're not responsible for what sales does with the leads. They're not closing them properly, et cetera, et cetera. We've all been there in those sort of, we've thrown the leads over the fence and they're not being acted on properly. The salespeople don't do it right, or sales says the marketing leads aren't that good. That's just not the way a modern SaaS company operates. It's all collaborative. Let me ask you, Alok, quickly, what are your top 3 recommendations in terms of, thinking about how do companies operationalize the key metrics that are going to help them drive efficient growth in 2023? What are the top 3 recommendations that you'd have?
Got it. Actually, I'll make one recommendation, which is asking a question to yourself, and second is more of a recommendation. The first thing is about basically asking this question, which I've been often asking a lot of founders and CFOs of late, and I get very interesting responses back. Most of the times, or a lot of times, actually, the answer is like somewhat surprise and kind of unclear kind of answer, where whatever your operating or financial plans that you have made for the year, let's say you achieve everything that you have set out on your budget or the plan. Do you have a sense of how will your business be valued? Like, we are setting all these goals internally in the company. We have this annual operating plan. We do revised forecasting. We set various team goals. But how does this map into the overall valuation of the company? At the end of the day, everyone is working in the company, in these early stage growth companies, venture-backed companies, for increasing the value that the company is creating. Is there a visibility in terms of what will be the outcome that you will have? I think that's a very, very important question to ask. If you're not asking that question, my recommendation is to actually ask that question. What does your plan lead to in terms of the value? And if you want to discuss this in a one-on-one set, I'm very happy to do that. This is a topic that is very, very close to my heart in terms of how do you bridge the gap between the valuation and whatever you've done in terms of the planning. So that is my first recommendation, more as a question that I think we all should be asking in our business.
That's a very thoughtful, great question.
Second is more of a recommendation. Quite often we get into this daily challenges that we all face in our companies. We all struggle, and it's not something that we have talked about so far in this discussion. It's about this whole notion of data quality. no company has got good data quality. And often people say, hey, my data quality is not good. How can I do all this fancy stuff that Amit is teaching me? How can I do all this fancy stuff that Lauren or Alok are talking about? They are probably things that I should be doing maybe in a year from now or 2 years from now, once my data quality is a little bit better. But one thing I've noticed by talking to various companies, whether they are small, mid-size, or very, very large size, data quality is never great. You will always have this viewpoint that tomorrow my data will be better. In future, I'll be able to do all the nice things that are being told to me which are good for my business. But today is not the right time for me. I think actually that is not a good mindset. Today is the right time. Don't actually delay this anymore. And it actually brings in this mindset of actually taking these baby steps actually in terms of figuring out where your data is broken. If you just start adopting these practices that Amit was talking about as an example today, you'll start realizing where your data is broken, where your model is actually getting broken. And then you'll start putting in the right instrumentation in place, and your data quality will improve a lot more faster, a lot more quicker in the right form, shape and form, compared to if you have this hypothetical view that I'll do it over a period of time, I'll start doing this stuff in 2 years from now. So don't get deterred by the data quality in particular, and then take the baby step, get onto this journey. These are actually the two things that I would recommend.
I just want to add to that because that is awesome. 5 years ago, I would say a lot of the investors that we talked to didn't really care about the systems that a company had when they, were investing in it or acquiring. Most recently, what I've been hearing from numerous investors is that they actually calculate the speed at which a company can answer their questions, and that they can supply good quality data that when they then dig into that it's actually accurate. So the investment in systems and data tracking is absolutely worth it, and it's paying off in terms of valuations. So Amit, do you want to have a closing thought here?
Apart from whatever you and Alok added, I would say that have a North Star, because not having a North Star will not give you direction. Think of the company, like Alok mentioned earlier, that it is the company that you started with your own money. Because if you all don't have that mindset, if the mindset is that I'll continue to raise rounds without showing a path to profitability, then all that we spoke over the last 1 hour has little or no relevance. So have a North Star, and then think of this plan like you own the company. I think that becomes a main derivative of performance of the company as well.
And just in closing, this is some Bain research that I would share. In difficult economic times like we're in today, it's unclear what the environment will bring, but there's always winners and there's losers. And it's interesting, I heard recently that in the height of the dot-com boom, 5,000 companies were funded. In the last 2 years, over 50,000 companies have been funded. So there are a lot more companies out on the market. It's great because we're in a much bigger market space for SaaS than we were 20 years ago. But the focus on succeeding in this environment is it's a great sort of prism to be working in, because it makes companies make better decisions, be more data-driven, and be more operationally efficient. And we're excited to have everyone on the webinar today. Thank you so much, Amit, and for all your input. And I'm excited to see what Whatfix does in the future, and same with Drivetrain and Alok. Thank you so much for your contributions today. This has been terrific.
Thanks, Lauren, for having us.
Thank you.
Take care, everyone.
Hi, everyone.